Hello, and welcome to my channel, The Entrepreneurial Mindset. My name is Jay Berman, and today I'm starting a new series of episodes called Essential Accounting Concepts. Today will be episode 1. The concepts in this video come from my book, Is Your Business Idea a Good Investment?, which is available on Amazon.com as a Kindle version only. Go to the Amazon search bar, select books, type in my name, Jay Berman, scroll to my book to purchase, and by doing so, you support my channel and my work. Thank you. So today's essential accounting concepts, I'm going to start with the income statement, the revenue, cost of goods sold, gross profit, and gross profit margin. If you've never had an accounting course ever, I recommend you learn Microsoft Excel or Google Sheets to learn how to calculate your own spreadsheets. So the first line of an income statement is, well, the top line of an income statement is called revenue. It is also called sales. It's also called gross sales or gross revenue. The amount of money a company earns selling goods or services, or both. It's often calculated by, you can do it by day, you can do it by week, month, and by year. And revenue is simply calculated by the price of the good and service times the number of paying customers. Now, revenue has to be recognized. So what does that mean? For revenue to be counted, the revenue earned must be recognized. Revenue recognition occurs when, especially in a B2B situation, so if you're selling strictly to businesses, any of these can occur for the revenue to be recognized. And I'll explain in a minute why revenue recognition is important. So when the seller delivers goods or services to the buyer, the revenue is recognized, whatever the value of those goods and services are. The buyer claims and accepts ownership of the goods. The seller expects revenue by the due date. So if you were going to be in a B2B situation, in other words, you're selling strictly to businesses, you're going to be issuing invoices. So all likelihood, you're going to be delivering goods and services, and then you're going to be paid later. You've probably heard of the term 30, 60, 90 days. It's very common in retail situations. The buyer pays the invoice within the 30, 60, 90-day terms, and the seller receives payment. So if one of those situations occur, revenue is recognized, is counted on your income statement. So why is revenue recognition important? Well, it's important for income tax purposes. Revenue is recognized in the year the company earned the revenue and not the year the company was paid. So I'll give an example here. Let's say your company delivered goods or services in December of 2024. Your company was not paid until January of 2025. Well, you must declare the revenue in 2024 for income tax purposes. The IRS doesn't care when you get paid because want to know when you earned the income, not necessarily when you get paid. Now, after revenue, the next line is cost of goods sold, or called COGS. Cost of goods sold is the manufacturing cost of producing the goods. It's also called the variable cost directly tied to producing the good. In a previous video, I discussed what a product is. It's either a good or a service. So cost of goods sold is really strictly involves goods, which are tangible items that you own, such as clothes, shoes, furniture, appliances, cars, personal care products, food. Those would be considered goods because they're tangible things that you can touch, you can smell, you can see, you can feel. And cost of goods sold is really not relevant for services. Services are things that you experience, and you usually rent services. So a good example is your cell phone. You can own your cell phone, but you do not own the cell phone service. So here's an example of cost of goods sold. Let's say you own a clothing store. The unsold shirts on the shelves are called inventory. And inventory is an item listed on the balance sheet under current assets. And in future videos, I will discuss what a balance sheet is and what a current asset is. But for the time being, just understand that if something is unsold, any good that's unsold, from food to cars, is considered inventory. Now, once a shirt is sold, in other words, removed from inventory, that shirt's cost is recorded on the cost of goods sold. The shirt's retail price is recorded under revenue, and then the cost of that shirt is deducted from revenue on the income statement. After cost of goods sold is now the next line, the third line, is called gross profit. And what is gross profit? Gross profit equals revenue minus cost of goods sold. So you have revenue, cost of goods sold, and then you have gross profit. Gross profit is calculated as revenues minus cost of goods sold, and then divided the difference by the revenues. Gross profit margin. Okay, so gross profit margin is revenues minus cost of goods sold divided by revenues. So here's an example of a very basic income statement. Let's say your revenues in 2024 was $100,000. Let's say you were selling shirts, and the cost of goods sold was $50,000, so it cost you $50,000 to have those shirts manufactured. Now your gross profit is $50,000. So it's very, very simple. It's $100,000 minus $50,000 equals $50,000. Your gross profit margin is, in this case, 50%. Now, if you are going to be selling goods, I highly recommend that your gross profit margin be 50% or higher, because that gross profit margin then has to cover the rest of your expenses. And the higher the gross profit margin you have, the better chance you have in paying for your operating expenses. If it's less than 50%, then you're probably your goods are probably being manufactured too expensively. You may want to find a cheaper vendor, supplier, manufacturer for your goods. So again, if it's 50% or higher, you're in good shape financially to pay for the rest of your expenses and to earn a net profit. So that's all I have for today. I will continue with these episodes regarding accounting. So if you have any questions or comments, please use the comments section below. Subscribe to my channel for more educational content about entrepreneurship, and thank you for watching.